boom and doom report. Marc, you have been quite outspoken in your views about the American stock market since 2009. You said that if central banks print money out of thin air, it has to go someplace, and a lot of it would end up in asset markets. And you were absolutely correct about that. But you've also been quick to note that when central banks eventually take the punch bowl away, markets will plummet. But then you went on to say that even if that happens, at some point when things get really bad, central bankers are going to come back and print more money. So let's get an update on your view in where we stand in this story. You've clearly gotten this right so far. Are we at the point where central banks are running out of bullets, or asset markets headed lower? And at some point, do you think they're going to come to the rescue with QE4 or some other negative interest rates or some other kind of stimulus?
Well, basically, thank you for the introduction, and I'm very happy to talk to you. I think that it's important to understand the government, the Treasury Department, and the Fed is one and the same. They can manipulate markets, and they've taken measures after December 2008 and kept interest rates artificially low for a very long period of time. And then last December 2015, they increased the Fed fund rate to 0.25%. Probably precisely at the wrong time. But that aside, my view is that if the stock market drops by, say, 20% off the peak in May 2015, that's soon 1 year, by more than 20%, they'll take additional measures. Now, in many countries, we have already negative interest rates. The Fed can do the same. I'm not sure about the Constitution, whether it would be constitutional to introduce negative interest rates. But there is not many people care about the Constitution anymore. So it's a possibility. The second possibility that is coming up now more and more by some economists is helicopter money. Helicopter money would be, instead of just launching QE4, to actually send each household, say, a check for $1,000 or a check for $10,000 or whatever it is. Now, I'm not sure, again, if Congress would agree to such a measure, because the Congress at the present time is to a large extent, or the Senate is controlled by the Republicans, and whether they would agree to that measure is questionable. But it's a possibility. And what they also, I think, can do is essentially to abolish paper money. If you abolish paper money, you can introduce less than zero interest rates, and that would obviously hurt savers, but it may not boost consumption and the economy, because in countries like Sweden, Denmark, Finland, Switzerland, we already have negative interest rates, also Japan now, and it doesn't boost the economy because people feel insecure, they feel worried about it, their savings are no longer giving them any return. So the reaction in most countries has actually been that the savings rate goes up, and that is basically near-term negative for the economy. I think it would be good for the economy in the U.S. to have a higher saving rate in the long run, but near-term it has a negative impact. So my view is yes, I think, you understand, the government and the Fed and the Treasury and also the academia at universities is essentially controlled to a large extent by neo-Keynesian interventionists. They think they are smarter than you and me, that they need to intervene into the economy, intervene into the free market. And we've seen what a disastrous result that had. It had the consequences of the Nasdaq bubble, then the housing bubble, and then the financial bubble in 2000, 2008, 2007, 2008, the subsequent greatest recession since the Great Depression in the 30s. So their interventions have largely failed, and I think that will continue to be the case. But you understand, people who are so arrogant and conceited as the academics at central banks and so forth, they will not shy away from increasing the dosage. In other words, like you give to a patient antibiotics and they are useless, they don't achieve the desired results, so you double up. And the doubling up will not help at all, but that's what the central banks, in my view, will do.
Well, you make an excellent point about helicopter money. It's something that I think a lot about. You know, the whole market just assumes that the Fed is going to be there to rescue the market. And I think politically it's very possible that the people will stand up, especially in an election year, and the next round of quantitative easing will be helicopter money, QE for the people, not for the bankers. And it won't bank.
Well, helicopter money is basically a combination of fiscal policies and monetary policies. Basically, if the Treasury sends a check or the Fed to every household of $1,000, say, it can boost economic activity for a month or two. You know, and then people can go out and drink more in a bar or spend more in McDonald's or restaurants, go on a holiday and so forth. But in my view, the impact on the U.S. economy will be very small, because if people buy goods, most of the goods are imported anyway. So it's not going to boost the U.S. economy much. And once you have launched helicopter money 1, you may have soon to launch helicopter money 2 to sustain the spending. So all these measures, they are quick fixes. Like if you have a house and the cracks in the walls, you just put some paint on top of it. It looks nice for a little while, and then it gets worse and worse again.
Okay.
It's a typical, helicopter money is a typical measure that occurs in Botox economies. You just fix, but you don't improve it in the long run.
An act of desperation to cover over the symptoms. Let's move on now to Asia and emerging markets versus developed markets. Most Westerners are used to thinking of Asia as a place whose economies are almost entirely dependent on manufacturing exports to the West. Most Westerners continue to assume that Asia doesn't really have any middle class to speak of, and that its economies are completely dependent on exports. Those are all old stereotypes, though. In your January Gloom, Boom, Doom report, you had an excellent piece on the growing and advancing economies of Asia and South Korea in particular. So please give our listeners kind of a high-level perspective. What's going on in Asia in terms of high-level trends, and what will this mean for emerging markets investors in coming years?
Well, first of all, I think Westerners don't quite understand that in Asia, if you start Asia from the Middle East up to Far East Russia, and in the south from Australia, New Zealand to the north, Mongolia, Kazakhstan, Russia, that there are roughly 4 billion people in Asia. So it's a much larger population than what we have in the Western world. China alone has 4 times as many people as the US and the EU combined. And when I came to Asia in 1973, Asia was very poor. And even in the 1980s, I had a wealthy client from Chicago. He asked me in the early 80s, Mark, how is it that Asia is so poor? But that is no longer the case. We have some very rich countries measured by GDP per capita. The first one to really develop was Japan after the war until 1990, and then South Korea, Taiwan, Hong Kong, Singapore followed. And then after 1978, China began to open up, but it was a very slow process. But after 1990, it took off. And so when people talk about Asia, they don't realize the largest beer brand in the world is not Bud Light, but Snow. It's from China. And the second largest is Tsingtao, also from China. Among the 10 largest beer brands, 4 are Chinese. There are 120 million Chinese that travel outside China every year, much more than Germans or US traveling overseas. And they are not poor people. On a per capita basis, the Chinese in Thailand are the largest spender, according to the Tourist Authority of Thailand. So we have already a big middle class, and it's a myth to think that Asians don't consume. They consume a lot. They are the biggest internet users in the world, and. Anyway, the point is China is now slowing down, and massively so, and maybe they have a financial crisis or already are in a financial crisis mode, which is unlikely to end well. But equally, there are areas in Asia, like Indochina, that still have a large potential. Indochina being defined as in the east Vietnam, northwest Laos, southwest Cambodia, Thailand, Myanmar, in other words, the old Burma, India, Bangladesh, and in the north, Yunnan province of China, and in the south, Malaysia, Singapore. That region receives at the present time huge foreign investments, also for political reasons, because the Chinese are investing a lot of money in these countries. And so the Japanese, the South Korean, the Taiwanese, under American influence, are also doing it to counterbalance the Chinese influence. And so we have, although growth in Asia is at the present time practically non-existent, but in these countries there's still strong growth in terms of exports, industrial production, and per capita incomes.
I'd like to move on to a listener question that was posed in our listener discussion forums at macrovoices.com/forums. Diego in Mexico described his fascination reading your article about South Korea in the January Gloom Boom Doom report because he saw so many parallels between his own country of Mexico and South Korea going back to the 70s in terms of low GDP and a lot of the things that you described in that article. Diego can't help but wonder, though, what went wrong for his country, because it seems that Mexico has not had anywhere close to the success of South Korea, despite having started from some of the same fundamentals in terms of GDP per capita and so forth. So what did Mexico get wrong that South Korea got so right?
I think that's a very good question, and I think that we have to look to a large extent at the mentality of people. Arnold Toynbee, already the historians, pointed out that some people in cold climates, they are more thrifty and have a higher savings rate and have higher work ethics than people in warmer climates. And I believe that the Koreans, they did what the Chinese do today. When Japan was already quite rich in the 70s and very successful in terms of eroding the lead of U.S. car makers, Korea was nothing, Taiwan was nothing. But they copied the Japanese, and the Taiwanese did the same, and the same happened in Singapore. And these are people who have a hard-working mentality. I mean, I don't want to sound racist, but how many semiconductor plants are they in Africa? I think a lot has to do with there is corruption in Asia, but less so probably than in other countries. And these countries like Korea, Taiwan, Singapore, Hong Kong, they didn't have any agriculture. So people either had to work or starve. There was no going back to the countryside and enjoying the fruits of the earth. Like I live in Thailand. In Thailand, the curse is that there is an abundance of food. So people don't really have to work very hard if they don't feel like coming to their jobs in the morning or suddenly have a different view. They go home to the families in the countryside, and there they have enough to eat. They don't live in luxury, but they have enough to eat. And I think very few countries in the world will achieve the success of, say, the European countries in terms of having risen to relatively high wealth in the last 200 years through the Industrial Revolution. Very few countries will achieve the success of the US until the 1950s, 1960s. Since then, it hasn't been all that great. And so I believe really successful economies are more the exception than the rule. But I have sympathy for Mexico. I go to Mexico quite frequently. And I think actually that it has quite a good potential. But exactly why it hasn't been able to capitalize on its potential, I'm not so sure.
Let's move on to another high potential country, India. Most Westerners don't think much about India as an investment target, but I know that you not only invest in India yourself, but you also serve as the chairman of India Investment Fund. So India is clearly a market that has your attention. Please give our listeners the elevator pitch on India. Why would people care about investing in India? What's the case for India?
Well, basically, the case for India is that it has been cursed by socialism and policies of isolation until, say, 15, 20 years ago. And then it began to open up, but it still had a horrible bureaucracy and laws and regulations that are very unfavorable to growth. Now, it doesn't mean that some companies didn't grow a lot. We have 30 years ago, there was no IT industry in India, and today it's a center of the IT industry and of the outsourcing of software programs and so forth. So they've done relatively well despite of the government. To move really ahead, they need a strong man that can override the different factions and can reduce the bureaucracy meaningfully. Now we have Modi, he's the Prime Minister of India. He's a reformer. He'd like to do that. But it's very difficult for him to do it. You understand? In China, Xi Jinping, he can take any measure he likes. He has the power. But Modi doesn't have the same power in India. And so the potential for India is, of course, huge, because in about 10 years' time, India will have a larger population than China. And whereas, say, China consumes more than 10 million barrels a day of oil, India consumes less than 4 million. In other words, the GDP per capita is much lower in India. And the potential is there. Whether it will be able to capitalize on its potential, that is not entirely clear. But equally, I think, someone who manages a fund in India, and that applies to all emerging markets, there will be a lot of consolidation. In other words, companies taking over smaller players. So I think a stock picker probably can do quite well in India, and by the way, throughout the emerging world.
Okay, let's move on to real estate next. Most Americans have either never heard of China Beach or they know it only as an old TV show about American soldiers that were stationed on some beach someplace in Asia. Let's fast forward to 2016. Bring our listeners up to date, Mark. Where is China Beach? What's going on there today? And why have some international real estate investors recently taken an interest in buying properties there?
Well, basically, when I was young, in the 50s and 60s, we went to Spain, and there were lots of resorts that just started. I mean, Torre de Molinos was very, very small village. Benidorm had a few hotels, and that's it. And these became eventually huge resort areas, huge developments for tourism took place, and so forth. When we first went to Vietnam in '89, there was nothing at all. And we then built a hotel, and the hotel is still there and it's successful. But because of some, not dispute, but some problems among the partners, we sold it then, I think in '95 or '96. And then we developed another hotel, the Nam Hai, is a 5-star hotel, which is very successful. But that whole coast, if you visualize Vietnam as a snake, in the north you have Hanoi, at the north, and in the south Ho Chi Minh, and on the coast facing China, in the middle you have Da Nang. North of Da Nang is Hue, the old capital, and south of Da Nang, about 30 kilometers or 30 miles from Da Nang, is Hoi An, is a UNESCO protected city. And that whole beach will become a huge thing. We have now a hotel, I think it's called the Crown Plaza, and it receives 15 charter flights of Chinese a week that go there gambling. The gaming money there, the gross gaming revenues monthly are $3 billion, just one casino. It's a lot of money for one casino. And the attraction of China Beach is it's relatively close to southern China. In other words, the whole of Guangdong province, Hong Kong, relatively close to Taiwan, relatively close to South Korea, because the Koreans, they like to go there for golf. And the Koreans, because of their climate, they don't mind that the coast is a little bit on the cool side in winter time. So there's lots of Koreans going there, and there are, I think, 3 flights every day from Japan into Da Nang. It's also becoming an industrial city. So that region is becoming very big, as well as, by the way, Cambodia. Cambodian exports late last year were up 20% year on year. Not many countries have exports that go up by 20% year on year. Certainly not the Japanese. And in the US in December, exports were down 6% year on year. So it's a boom town, and Laos is still the Asia that existed, say, 40, 50 years ago, is also being developed, and Myanmar as well. So all these countries in this Indo-Chinese region, which I described before, are going to grow a lot. The problem for foreign investors, unless they go there themselves, Vietnam has a stock market. People can buy Vietnamese stocks, but there's essentially no active stock market in Cambodia and in Laos and in Myanmar. So people have to invest through direct investments. And then there is a relatively high execution risk.
Okay. So definitely a sophisticated investor's market, but a lot of opportunity.
Like the early investors in America, the ones that really made money is the ones that went to America and lived in America foreign investors in America, they lost money in the 19th century in railroad bonds, in canal shares. They lost a ton of money.
So it sounds like Vietnamese beach real estate is a boots-on-the-ground investment for people who have the resources to be there and monitor their investment.
Yes, I mean, you see, Asia is still early days. Say in Asia, very few people have second homes. There are some people in Hong Kong that have second homes, say in Phuket, in the south of Thailand, and some Chinese may have a second home in Hainan Island and so forth. But by and large, it's early days, also in India. And because of cheap flights nowadays, people can actually travel without incurring huge expenses. So tourism, in my view, is a high-growth area going forward.
Okay, we've talked a lot about the good news stories in Asia. I want to move on to some of the not-so-good news stories, specifically
Yes,
China and their predicament.
My specialty.
A lot of people are focused on the Shanghai Composite Index right now. In other words, they're looking at stock prices. But I think a lot of Western journalists fail to really understand the credit growth story in China. So I'd like to start with, the 2008 credit crisis in the United States was caused by too much debt, much of which was under-collateralized or unserviceable due to expiring teaser rates. Please contrast China's credit picture in 2007 with what it looks like today and explain what the implications could be for markets and investors going forward.
Well, basically, what happened after 2008, the recession in the U.S. officially ended June 2009. But already in December 2008, the Fed slashed interest rates on the Fed fund rate to zero, basically. And that combined in China with very expansionary fiscal policies. In other words, as a percent of the economy, they had an even larger fiscal deficit than the U.S. And they also printed a lot of money, led to a colossal investment boom. And by the way, not just in China, but in other emerging economies. If you look at capital spending in emerging economies as a percent of the global economy between 2005 and 2014, it doubled. Now it's no longer growing and it's going to contract. But what happened is in China there was a huge credit bubble that financed this capacity expansion. And now, not only in China, but in other emerging economies as well, they have these huge overcapacities. And so when you think about it, what the Fed's policy did, the central banks and the Fed basically wanted to create inflation. First of all, it's very questionable whether to have inflation is good or bad. But let's not talk about this now because it takes a while to explain. So in the 19th century, the U.S. had deflation and strong economic growth. So it's wrong to say that deflation is bad and inflation is good. But basically, the Fed wanted to create inflation, but with these artificially low interest rates, they created a huge credit bubble in lower credits. In other words, practically every company could just borrow money because if I, as an investor, can't get any money on my deposits, I'm tempted to buy the bonds of a company that, say, has a yield of 6%. And so there was a huge growth in lower quality bonds, the so-called junk bonds. And we had this huge credit bubble building up in China, where credit as a percent of the economy over the last 6 years went up by 50%. According to the Bank of International Settlement, no country in the age of capitalism has experienced this kind of credit growth in such a short period of time. So we have this credit bubble, and it will have to be deflated one way or the other. But you understand, we can have a crisis in China. If you look at the US 1800 to today, we had in the 19th century already more than 15 economic and financial crises. The canal boom and bust, the railroad boom and bust, the Californian boom and bust, the Chicago boom and bust, and so forth. And then we had the Civil War, and we had World War I, and then we had the Great Depression and World War II. But despite of all these things, the economy continued to grow in the long run. So I think that China has a problem at the present time, and that it will be bad for a while, but that in the long run, China still has a good potential with one proviso. We need peace in the world, and that is not guaranteed.
Unfortunately, I couldn't agree with you more on that one. I'm curious, going back to China, Kyle Bass has been very outspoken about his decision to commit more than half of the $1 billion of assets that he has under management to a short play on the Chinese yuan. Basically, the bet is that China will have no choice but to continue to devalue dramatically from where they are already. Would you agree with that view? Do you think Mr. Bass is onto something, or do you think he's overreacting to the situation there?
Well, yes and no. Basically, the difference between some other countries that had to devalue significantly and China is that China is not less competitive. It is more competitive than before. The trade surplus in China is going up, not down. Now they have a large capital flight, but in my view, if the Chinese really want, and maybe they have an agenda for having this large outflow of capital, who knows? And some of it is direct foreign investments, like they bought a Swiss, or they're buying a Swiss agricultural company that is similar to Monsanto. They're paying over 30 billion US. So some of the capital, outgoing capital, is actually not capital flight per se, but investing overseas. And number two, the Chinese are not totally stupid. They know what Kyle Bass' position is, and they also know what Soros' positions are. Every Chinese anywhere in the world is a potential spy for China. And so they're very well informed about everything that is happening. And the bets on a lower Chinese currency depends to a larger extent on US dollar strength. Now, in my view, and I cannot say I know for sure, but say put yourself in the position of the Chinese. They see the Chinese, the one thing they don't want to do is to lose face. So when they see some hedge fund managers that could essentially make money from shorting their currency, they will do everything that these hedge funds don't make the money. That I can assure you. So what in my opinion happened is the people that were short the RMB or the yuan were also short the yen and the euro. And so the Chinese, with their reserves, what is it for them to shift, say, 100 billion or even 500 billion out of US dollars into euros and yen? So they pushed up the yen and the euro, and they weakened the US dollar. And so some of the pressure on the yuan has gone away. Now, you understand, all central banks are manipulators. In a free market, manipulators, they go to jail. It's a crime. But central bankers is like some pigs are better than other pigs. And the central bankers, they can manipulate everything and they don't go to jail. So in my view, the Chinese still have some ammunition. I'm not sure it will be successful, but I can tell you that for China, there is zilch advantage to devalue. There's no need.
Okay. Let's move on to precious metals next, particularly gold. You had an excellent article in the January Gloom Boom Doom report from one of the Nova Gold executives. They have a very bullish picture. I can't help but remember 2008, though, when gold initially popped, and then as everyone started to panic, gold sold off with everything else. And I look at the continuing strong dollar story and a lot of fundamentals that suggest to me that maybe gold is not done with its correction. What do you think? Is it time to buy gold here? Does it still have more downside? Are you putting faith in this breakout that we've seen in the last few weeks?
Well, I kind of indicated before that we have this manipulation in markets. And I think it's very difficult to make any prediction because like if tomorrow the Fed announces QE4 and not just $85 billion a month, but say $200 billion a month or anything, you can move markets. So we don't know. But the one thing my sense tells me is that when you have negative interest rates, and now there are $8 billion worth of bonds, of sovereign bonds that trade at a negative yield. When you have that, the holding cost of gold is relatively low. Gold you can't print. There is some mining supply, and I agree with that. There's some central banks selling and some manipulation probably. But basically you can't print it as easily as paper money. And in view of the fact that the academics, in their desperation and after having essentially largely failed to boost economic activity, that they may move to electronic money. In other words, you abolish banknotes. In view of that, I think that every investor should hold some precious metals. Now, someone may say, I will only hold 5% of my assets in precious metals, and somebody will say, I want to have 50% of my money in precious metals. I tell everybody, my, say, simpleton asset allocation is roughly 25% real estate, 25% equities, 25% bonds and cash, and 25% precious metals.
Okay, and what about the question of precious metals versus mining stocks? It sounds like your view is because of the potential of some extreme risk, you really favor physical precious metals over the stocks. Is that right?
Yes, but I've written about this. The mining stocks worldwide, as of, say, the third quarter of last year, became incredibly depressed. You had American Barrick at $5.50. Now, the day before yesterday, it went to over 12. There's sometimes when it's worthwhile to buy the miners because they're so incredibly depressed. Equally, there's sometimes when it's the time to sell the miners because they've been driven up by enthusiasm and excessive bullish sentiment. So I would say right now, if someone has a higher risk appetite and he wants to make money, the gold miners are probably more interesting. The bulk of my precious metal exposure is in physical gold, not miners. But I've bought some miners. Actually, I sold some the other day, but I may buy them back or will buy them back.
Okay. Before we close, I want to take a moment to compliment you, Mark, on the Gloom, Boom, and Doom report. I've noticed that a lot of, well, you deserve it, and it's amazing. The newsletter guys, most of them are all telling the same story. One of them writes a good article about something, then all of the others are writing an article about the same subject. You're in a completely different category. Every issue is completely new content. It's always full of graphs and charts, and it's always interesting. So I really want to compliment you on an original, thoughtful, and very interesting thing. So tell our listeners, please, where they can find out how to subscribe.
Well, the best is probably to go to the website